conversations with people who are domain experts on subjects that are in the news. I am Monojit Majumdar. I mean, you can see my name there. I'm the editor for explanatory journalism at the Indian Express. This session is about the economy, where we are now and what we should be expecting in the new year. Now, obviously, there are several questions. There's manufacturing growth has been weak and investments have been muted, as a result of which we had a sharp slowdown of real GDP growth in the second quarter. So is it likely that we will have some kind of a turnaround in the remaining part of the current fiscal? Then the geopolitical situation continues to be very fluid. Will that influence domestic growth? We have a new RBI governor. So what will be the priority of the RBI under its new head? Now, the Fed only yesterday cut rates. Will the RBI, when can we expect the RBI to? I mean, there's so many of these questions. And to explain all of this and other questions, we are very honored to have you with us, Mr. Sabnavis, Chief Economist, Bank of Baroda. He has been a corporate economist for more than 3.5 decades. He keeps appearing in almost all the stories that we write, because there's almost always, we always go to him, and so many others also do, for a comment. There are these wonderful reports that Bank of Baroda does. They're always quoted in the reports that we do. An author, commentator, columnist of great repute. Welcome to the Indian Express. Thank you for your time. We are very grateful. Thank you. Speaking to Mr. Sabnavis will be my colleague, Assistant Editor Hitesh Vyas. Hitesh, veteran markets and economy reporter for the Indian Express, and he covers most of the stuff that you read on these subjects in the paper and on our website. The way this will work is that Hitesh and Mr. Sabnavis will be in conversation for about 35 minutes, maybe 40 minutes. After which we will take some questions. Today's explained event is brought to you by our partner, Plutus IAS. My thanks to our partner, very important. Thank you all for joining. All of you have been listening to our conversations before this, and thank you very much. Welcome once again. Hitesh, yours.
Thank you, Mr. Sabnavis. It's always a pleasure to have you, and we are all excited to listen to you, sir. I would start with growth. We saw that in second quarter, our growth slowed to around 5.4%, sir. What was the reason for this slowdown in growth?
Okay, first of all, good evening to everyone. And thanks a lot, Monojit, for a very, very generous introduction. And thanks, Hitesh, for inviting me out here. Now, I think this particular question has been in the mind of everyone, that because all the time we keep saying that India is the fastest growing economy, going to grow at over 7%, so on and so forth. We have had these dreams of making India a 5 trillion economy, 10 trillion economy, a developed nation with various targets. So when we got this number of 5.4% for the second quarter, personally, I was a bit surprised, because we were looking at a number of around 6.6, 6.8% for the second quarter. Now, why exactly did we have this kind of a low growth number? Now, I think as economists, what we do is we look into the basic numbers which go behind this 5.4% growth. So what we do is we look at the different sectors and see how different sectors are fared. So broadly speaking, the economy is divided into three parts. We have what we call the primary sector, that is agriculture. We have the secondary sector, which is called industry, which has mining, manufacturing, and electricity. And then, of course, we had services. Now, when you look at the breakup of all these sectors, a very interesting picture emerges. We've seen agriculture doing very well. We've had very good growth in agriculture. We've seen very good growth in services. So when you're looking at services, what are we looking at? We're looking at trade, transport, communications, financial sector, real estate, public administration. So services were also doing well. But when you look at the industrial sector, you look at mining, manufacturing in particular, and also electricity, we saw that growth came at around 2.5%, very anemic. So this actually set us thinking as to why is it that growth has actually slowed down. Services were doing well. We also saw that agriculture was doing well. And this was before the Kharif harvest, because the Kharif harvest takes place from October onwards, in September, but primarily in October and November. So agriculture has done very well. services. People were spending a lot of money on services. But when it came to manufacturing, we saw there was generally a problem which was there. So when you deep dive into manufacturing, it says, so why is it that manufacturing is actually slowed down? So I think what we have realized is that it's primarily a demand problem. And this is sort of ratified by the fact that we've seen a number of these commentaries coming from FMCG companies, primarily in the MNC sector, who have actually said that there has been a case of urban stress. Now, all of us have heard of rural stress when the monsoon fails, but what exactly is urban stress? So I think when you go into this analysis, we found out that what they were really referring to is that on account of higher prices, higher inflation, demand had actually come down. Now, why should demand come down? Because A, as far as the companies were concerned, their cost of inputs have gone up ever since the Ukraine war, 2022. And they were holding back on the final increase in prices of their products. They've started doing it end of 23, 24, a little bit in 24, 25. So as they've been doing it, the price of their products have gone up. But more importantly, when we talk of inflation, we have seen that while inflation has been in this region of 5.5%, 6%, we keep getting these monthly numbers. But food inflation in particular has been double digits. The last number came maybe around 9.5%, but generally it's been very high. Now, what happens when we have high food inflation is that we spend more money on necessities, which means there's less money left for discretionary spending, and therefore we spend less on manufactured goods. So if you look at things like mobile phones, television sets, if you're looking at toasters, and other kind of household goods, people were spending less. Automobile sales were also lower in the month of September. And the last point is that, interestingly, we have this every year, but in the month of September, we have this period called Shraddh. So if you're a devout Hindu, you follow this practice of saying that we don't give to indulgence, we don't buy any consumer good. So this happens every year. It's a period of around 2 weeks, I think. I think Hitesh will be in a better position to answer this. But when we have this period of 2 weeks, people do not buy automobiles, you don't buy a mobile phone, you think it's inauspicious, you wait for the good times. So in the month of September, that is even before the corporate results came out, we realized that auto sales were down, but production was higher, inventories had built up. And when we go into October, November, we saw that what was production, what was inventories, those goods actually got sold in a month. So there was a kind of deferment of certain purchases which took place. So that also contributed to the lower growth which we have seen in the manufacturing sector. Now, surprisingly, we saw when you look at services, sometimes we ask the question as to why is it that services did well? Because we saw tourism doing very well, hospitality doing very well. In fact, I think lots of people were going for what we call experiences. So people wanted to travel. So whether we are earning a lower income or middle income or high income, everybody was traveling. Depending on your wallet, you went to a place, you stayed in a hotel of what you could afford. So the hospitality industry did very well in September, something which we have seen also in the months of October, November. So there's a kind of ambivalence which we see here where manufacturing has definitely been pushed back. But in terms of services, it was good. So therefore, on the whole, I would say when we look deep into these numbers, 5.4% number is not really bad. It's actually a fairly okay number, especially when we look at what's going to happen in Q3 and Q4, which we believe will be different. If you already have a question on that, I'll wait. Otherwise, I would try and explain what would be happening in Q3, Q4.
Yeah,
I'll leave it to you, Hitesh.
Yeah, that's what I wanted to ask you. How are you seeing growth in the second half, sir? And it's been third month of the third quarter. In the last 2.5 months, are you seeing any turnaround signs?
See, we have seen a lot of turnaround signs. Now, normally when you talk to different economists, you may get a different kind of a picture. But I would always say that if you want to get a right picture of what's happening on the consumption side, look at data. Okay, because I may be having an impressionistic view, you may be having an impressionistic view, because you, Hitesh, you are talking to lots of experts, analysts, you may get a certain view. But I say, look at the GST collections. GST is a consumption-based tax. GST collections have been over 1.8 lakh crores in October and November. What does this mean? This means that people are obviously spending money. One thing is to say that compliances have been better, which is okay. But how long will it be just compliances? But I would tend to believe that the GST data shows that consumption has definitely revived. It's partly because of A, we've had a good Kharif crop. We have seen rural spending picking up. And B, this is also the festival time where typically people tend to spend a lot on gifts, on products, or household products. So this is what we have seen. And that gives me reason to believe that consumption has picked up in Q3. And as consumption picks up, there's normally a case of saying that investment also increases. Now, investment data is not readily available. So when we look at the CMI database on investment intentions, a very interesting picture comes. If you look at April, May, June, there was hardly any announcements made because that was a time when we had the elections were going on. Private sector always likes to wait and watch, irrespective of what your perceptions are about which government is going to come to power. So what we saw was that private sector investment, the announcements made were really lackluster in the first quarter. But if you look at from July 1st onwards till date, it has been amazingly high if I compare it with last year, which means that there are signs that investment, private sector investment is also picking up. And therefore, I think that's a positive sign. And the last thing I would say is that government expenditure, that's the central government expenditure, it was lagging primarily on account of the election effect. And also the fact by the time you get your act together, you have all your ministries together, you decide to push forward your projects. The data we get up to October shows that there's not been too much of movement compared to last year. So if you look at what has been the overall capex expenditure, 11.1 lakh crores, and see what percentage, if I remember right, it's a little less than 50% has been spent. Compared to last year, it was about 50%. So therefore, there's been some kind of a lag when it comes to government expenditure on capital, on projects. Now, this, to my mind, is something which is going to change. And why do I say this? Because if you look at the kind of determination and the resolve which the government has shown in the past, based on pure experience, it looks like that will be very much close to the 11.1 lakh crores, which is supposed to be spent by March, which basically means that whatever shortfall has been there up to October is something which we can be fairly confident will be made up. So that's why we think that growth in Q3 and Q4 would average a little above 7%. So if I talk of the growth rates which we have had so far, average with 7% in Q3, Q4, we would end up with a number of around 6.6 to 6.8%, which I think is fairly reasonable. Talks of stable growth. We are still lower than last year, so we should admit that however good this number is, if compared with other economies, it's obviously still going to be impressive, but we are still lower than the 8.2% which we got last year.
So this RBI in its last policy reduced CRR by 50 basis points. How much do you think it will help in spurring the economy?
Okay, now when you're looking at CRR, conventionally it is a monetary policy tool which is used to indicate to the market that the RBI is loosening things. When I say loosening means we have had high repo rate for a very long time. I think ever since the Ukraine war, we've had a repo rate of 6.5%. Now, in the October policy, what did the RBI do? They changed the stance to neutral. For a very long time, they had what they call withdrawal of accommodation, which was very broadly defined as saying that if the repo rate increased from 4 to 6.5%, they felt that the deposit rates and the lending rates had not gone up by a comparable amount, which means that there is still scope for withdrawal of accommodation. So the overall message which was conveyed to the market was that the RBI thought that rates should remain higher for longer. And at the same time, they would still like to follow this policy of being cautious, or what one could say moderately hawkish. But in October, they changed the stance of withdrawal of accommodation to neutral. But they did nothing else. So the stance that's changed to neutral, the message taken by the market was that it was only a matter of time before the RBI would start lowering the repo rate. So the immediate reaction was that the bond yields came down by around 10 basis points. The 10-year bond was 6.84, 6.85, came down to 6.73. Subsequently, it went up. That was for a different set of reasons. So in between, what happened was we saw that the inflation number came at 6.2% for the month of October. Later on, 5.5 for November came after the policy. So the RBI obviously didn't have knowledge of that. But inflation again raising its head. The RBI now had to answer this question about, I've changed the stance to neutral. Inflation is still high at 6.2%. So what should be the next kind of messaging? At the same time, we also realized that the overall liquidity in the system had become tight. Why did it become tight? A, as I told you, the government has not been spending. So therefore, there's some bit of hoarding of money with the Reserve Bank of India kept in the government account. Because just for the sake of the public, when you and I pay taxes, the money is paid to the government. In the earlier period, this money would reside with one of the commercial banks, presumably a public sector bank. But the policy was changed a couple of years back where the government transferred this money to the Reserve Bank of India. So just think of a situation where we pay taxes, deposits come down, but the money does not go into somebody else's deposit. It goes into the government account with the RBI. So for all practical purposes, it's out of the system. So we saw this happening in a certain measure where we also knew that advance tax payments will be coming up on December 15th. So therefore, there will be further hoarding of money, which will be going to RBI. Now, there's regular GST payments which come up normally after 20th. So people start making payments. Again, there's a case of withdrawal of deposits. And towards the end of December, that is in the last week which we are going through, there is normally a tendency for bank credit to also pick up. So as you can see, the RBI is aware of the fact that there would be an acute liquidity issue in the sense that banks would be running short of money. So far, what the RBI has been doing is they've used their liquidity framework, which is essentially using the variable repo and the variable reverse repo operations, where essentially you borrow or you lend money to the banks. It could be an overnight. It could be for a period of up to 14 days. Normally they keep for around 3 days, 5 days, 14 days. So what they have done is they've already started having these variable repo auctions, what we call the VRR, they're called VRR, variable rate repo. So it will be slightly above your 6.5%, which is a repo rate. But I think the CRR is a very useful tool because when you cut the CRR, what does it mean? If I have 100 rupees of deposit, earlier I was keeping certain amount as a cash reserve ratio. The moment I reduce it by 50 basis points, automatically that 50 basis points from 100.5 of 100 rupees is something which is released to the system. So by doing this, the RBI has actually released around 1.16 lakh crores. They're doing it in two tranches. One would have been 58,000 crores on 14th of December, just at the time when the advance tax payments are made. And the second is towards the end of the month, that will be next week, so that you're able to ease liquidity. But the messaging is more important. It says that, look, I said I've changed the stance to neutral. I'm not in a position to change the repo rate, but I'm doing something called the CRR. I've cut the CRR. It takes care of conveying to the market that the rate cut is very much on cards, but it will all depend upon how data evolves. But at the same time, I've also supplied liquidity to the market. So I think there's a dual purpose which has been served.
Sir, you spoke about economy. You're seeing green shoots in the second half. I just want to understand how is global geopolitical situation going to influence our growth?
So when I'm talking of geopolitical, I think we'll have to look at geopolitical and other developments. Okay, because when I say geopolitical, normally we talk of politics, we talk of wars which are taking place, and invariably the question is what happens to crude oil price. Now, when we had the Ukraine war, we saw that the crude oil price went up. When the Israeli-Hamas conflict started, we all expected crude oil will again go to 120, 130 per barrel. I think, Hitesh, you have been talking to all of us economists and we gave all these fancy numbers. But actually nothing much happened. The world has actually adjusted to all these geopolitical problems which are there. So geopolitics, to my mind, today is less of a risk. And even if you look at World Bank data, they're talking in terms of crude oil price remaining between $70 to $80 per barrel for 2025, and even going ahead to 2026, we'll be in the same range. So I think today the global economy is quite insulated from these physical battles which take place, the politics part of it. But however, this said, when I talk of the other part of the external world, I think what is important today is what is going to happen when Donald Trump becomes the president of the USA. Okay, because at the time of elections, a lot of articulation took place. Now, what does the articulation say? The articulation said, we don't want migrants. We're going to lower the corporate tax rate. We're going to impose custom tariffs on everything that comes to our country, which we think is unfair. Now, all this means that inflation in the US is going to be higher because if I get rid of labor, I have to employ more people, pay higher wages, wage cost inflation. If I'm talking in terms of cutting corporate tax rate, the budget swells, higher borrowing, inflationary potential. I increase custom tariffs, automatically it's going to be again inflationary because prices go up. So this, to my mind, is one major problem which all countries are aware of. We don't know how much of this will be implemented. how much India is going to be affected. But given the fact that America is our major trading partner, this is a concern from the point of view of exports. On the other hand, you look at China. We know that when all this happens, China is not going to sit back. They're going to try and push forth their own exports. And how are they going to do it? You let the currency depreciate, which they're doing already. They will give a stimulus. They will try and produce more goods and dump it in other territories. So I think this is the concern which we have, more on the trade front. So geopolitics, through what happens in the Western nations, in particular US, is going to affect us on the export front, import front. And also, just before we had this discussion, Hitesh and I, we were talking about the currency. So we have already seen that the dollar has been strengthening like mad. All currencies are weakening. And it's left to the central bank to decide about to what extent do I go and defend the rupee. Because every time you defend it, you will have to draw down on your forex reserves. So that will be another conundrum for the Reserve Bank of India when it comes to this global situation.
You already spoke about inflation, but I just want to understand inflation has been elevated for some time, sir. We saw in October it touched 6.2%. In November, it has come down to 5.48%. What is driving this inflation?
See, if we look at inflation, there are two sets of products. See, first of all, I think we should be very clear about one thing, that inflation is a rate of change in prices. So when we say inflation is coming down, it's not to say that if I was paying 150 rupees for tur dal earlier, I'm going to pay 145 rupees now. It's just that 150 earlier was going up by 10% to 165. Now it goes up by 5%, and it's say 157, 158 per kilo. So I think that is something which everybody in this forum should understand. When we say inflation is coming down, it's essentially saying the rate of change of prices is going to moderate from 6.2 something lower. See, essentially two components which we look at. One is the food products that has a weight of around 46% in the index. And we have seen that food product prices have been going up because cereal prices have gone up. So cereal inflation was high. Pulses inflation was high. That is, we know your tur dal, urad dal, moong dal was expensive. When I say cereals, basically rice and wheat prices have gone up. And then we had this new joker in the pack called edible oils. We had negative inflation for a very long period of time. But in the last couple of months, we have seen the price of palm oil has gone up internationally because of high demand. To top it all, we have seen higher custom duties being imposed in India. So this is something which has engendered edible oil inflation, which we're seeing. So food inflation has been driven by, as I told you, cereals, pulses, edible oils, and then what we call top. Top is basically tomatoes, onions, and potatoes. These are seasonal products. Every year we have a crisis. We have production which gets affected because we have typically 3 seasons when these 3 crops are harvested. If there is excess rains or the monsoon remains for an extended period of time, like what we had this year also, with the monsoon withdrawing mid-October towards the end of October, the crop tends to get damaged. So we have had onion crop getting affected, tomato crop being affected, so therefore the prices have spiked. Now, this particular component to my mind, the rate of change of price is going to come down. We've already seen in the physical market, the absolute prices have come down. We were paying 80 to 100 rupees for tomatoes and onions. Today it's coming more into region of around 50, 60. If you're lucky, you may get it at 40 rupees per kilo. But we are used to prices in the region of around 20 to 30 rupees per kilo. So we are still away from that. But since I've seen the prices coming down from 80 to 100 to maybe something around 50, we have seen food inflation getting tempered. And the non-food inflation, what we call core inflation, which is non-food, non-fuel inflation, that has been fairly steady in the region of around 3.5% to 4%. So that is something which is moving gradually, crawling upwards, but it's not that something to be worried about. I think we will probably end closer to 4% for core inflation. But food inflation is something which could change the entire headline number, because if it comes down to something closer towards 5%, then we could be closer towards the RBI target of 4 or 4.5%.
RBI has revised its FY25 CPI inflation target to 4.8%. Sir, what is your expectation on?
Yeah, I think our forecast was 4.7. I think we'll go along with this number of 4.7, 4.8%. Because when we talk of an annual inflation, it's actually an average taken over 12 months. So we've had certain months where it did go low. In fact, we had 3.5 to 4% for 2 months before it went up to 5.5, 6.2%. So therefore, on an average, I think we would be getting this number of around 4.7, 4.8%. I think that's a fair enough assessment. Because earlier the RBI had an assessment of 4.5%. We had 4.5 to 4.7. So I think 4.7 looks more reasonable. So I think that's the kind of a number we're looking for the entire year. But more interestingly, I think for the fourth quarter, the RBI is talking of a number of less than 4.5%.
The RBI has been saying that they want to keep inflation at 4% on a durable basis. To achieve this level, what should be the ideal food inflation level you see?
Yeah, ideally, the food inflation number will have to be less than 5%.
Okay.
Because I think core inflation is something which normally has been in the region of 4 to 5%. I'll tell you what is the significance of core inflation. Core inflation is something which gives pricing power to manufacturers. Because I'm talking of non-food items. So if I'm producing toothpaste, I'm producing soap, I would ideally like to earn some additional profit from the price. So therefore, there has to be that 2 to 3% increase, which is necessary, otherwise production won't be viable. I can't be banking only on volumes to increase to keep my profits running. So normally we feel like 2 to 3% is something which is essential. Then because of what happens on account of input costs going up or the global factors which are there, rupee depreciating, all this actually adds to my input costs. So core inflation around 4% to my mind is fairly acceptable. Now, to get to this 4.5% of durable, low headline inflation, food inflation needs to be much lower than 5%. So I think that's when we can get it. It has to be 4, 5%. But the main challenge is that every year we have something called the minimum support price, which acts as a benchmark for lots of these crops which are being grown. They have been increased by around 3 to 5, 6%. This time I think it's been more to 4 to 6% increase in MSPs. So that itself adds that kind of weight to overall food inflation. So it's mandatory that we should be having a very good Kharif crop, very good Rabi crop. Then we'll be able to keep food inflation in the region of around 3 to 4%.
Sir, in keeping inflation under check, what more fiscal reforms should be done?
See, in terms of fiscal reforms, to my mind, there is little that the government can do. We should remember that agriculture is a state subject. So it is something which has to come in terms of improving productivity. We need to increase production. So the whole idea is that if agricultural, food prices have to be kept under control, supply is the issue. So one is increase productivity, especially of vulnerable crops like pulses, vegetables. These are the two things which are creating problem. Edible oils, actually, we have little control because we import 60% of our requirements. So if international price goes up, there's very little that we can do. The third thing is that we need to have a very clear exempt policy on agricultural products. When I say clear policy in the sense that if I have surplus, there should be a way in which I should be able to enable exports. Because very often the farmer says that by restricting exports, you're dissuading the farmer from taking advantage of higher prices in international markets. And last of all, I think when I'm talking a part of your exempt is that you need to recognize when there are shortages. Like I know very well that there's going to be a shortage in a particular crop. Let's assume tur dal. I know that there's going to be a shortage in tur dal. I should get into a position to start reckoning imports, because India is the largest producer and consumer of all pulses. So if I know that pulses production is going to come down, I should be tapping Australia, I should be tapping Kenya, I should be tapping Nigeria, Canada to make sure Egypt. These are the countries that typically supply pulses to us. So I think we need to have this kind of framework. But ultimately, at the end of the day, we need to have a good crop. What I'm saying is only firefighting to make sure you're able to mitigate the situation to the extent I'm able to get supplies. But prices will always remain elevated because of natural conditions.
There is a debate on excluding food from inflation targeting framework. What is your view on it?
See, I think this is a debate which will continue, but we should remember that, let's go back to the mandate which has been given to the Monetary Policy Committee. See, the MPC was set up by legislative action, and that legislative action said that the MPC is supposed to target headline inflation at 4%, with a band of 2% both directions. So once we have a mandate that we need to target 4%, we have to target headline inflation. That's important. I mean, that's a given. Otherwise, we need to change the legislative mandate to say that we should be targeting core inflation, not food inflation. Second, globally, everywhere in the world, central banks target headline inflation. They do not target non-food inflation. Food is an integral part because it has been proved by various papers which even the RBI has brought out to show that food inflation, when it's high, it feeds into core inflation at the secondary level. It may not happen immediately today, but it will happen with a lag of, I think, 2 or 3 quarters they've mentioned. I think it's 2 or 3 quarters is what their papers show. Because as your food inflation increases, there's a tendency for wages to increase, wage spiral takes place, and automatically core inflation also increases. So there's a link. Now, what can be debated, of course, is whether the weight of food is too high. That is absolutely essential. We need to keep revising our base years, keep changing the composition of the indices, because it's quite possible that the number of goods which are there in the basket today may not be too relevant, may not be having that kind of high weightage. So revising this particular thing is definitely, I think, which can be justified. But doing away with food, I think, unless we change the legislative action to non-food inflation, it has to stay.
Next question is on interest rates. Between May 2022 and February 2023, we had 250 basis point hike in the repo rate, sir. The last 22 months, it's been steady at 6.5%. So do you think RBI is behind the curve? Has the growth been neglected by keeping rates high?
No, actually, I have a totally different view here. I think there's a lot of discussion which says that if you lower the repo rate, it will help spur growth. In fact, I was just reading the minutes of the Monetary Policy Committee, and the 2 external members who actually argued for a rate cut this time have also brought up the issue of growth. Now, actually, let me ask a simple question to you, Hitesh. If suppose I give you a home loan at 2% today, will you go and buy a house? The answer is probably not. Interest is not the reason why you buy a house. You buy it because you have a requirement. You have the funding ability to service this particular loan which you're taking. So if I take it over to a corporate, I will be investing money today in case I see an investment opportunity. Just remember one thing, that governments can spend on capital expenditure because they don't look at profitability. A company spends on capital expenditure if it's able to justify a return on capital. So if I'm paying a 10% interest rate, I should be able to get 10 plus alpha or beta as a return on that particular investment. Now today, look at the capacity utilization rates in India. It's supposed to be around 74%. It was 76% in March. Now the RBI says in June it was 74%. So if I have surplus capacity, and I don't see that kind of demand for my product, there's no reason why I should be investing. So I will say, go back to the counterfactual, say that, okay, when the repo rate was 4%, why is it that investment did not pick up? Quite clearly, there was not much demand. So I think while theoretically this argument is right, that if you lower the rates, it becomes more congenial to borrow money. But at the end of the day, I think industry will borrow only if they see an opportunity, for which you need to see, A, I have excess capacity, and B, I need to see enough demand. Now today, for example, we see investment taking place. Renewables is taking place. It's a new field. Companies are investing in renewables. People are investing in steel. Steel industry is operating at 100% capacity utilization. There's a lot of construction work going on. There's demand for steel. However, if you go to the consumer goods industries, where demand is not there, there's no reason why they should be invested. And the last point I'll make here, Hitesh, an interesting thing is that today, nobody borrows at a fixed interest rate. Okay, I borrow today, maybe the rate of interest, let's assume the repo rate comes down from 6.5% to 5%. Let's assume my MCLR comes down to say 8%. So I borrow money at 8% today. Maybe next year also conditions are fine. The year after that, they're fine. I have taken a loan for 10 years. But after 3 years, we again see inflation going up. The repo rate goes up to 6.5%. The MCLR goes up to 9%. Automatically, my interest cost goes up. You take a home loan, the same thing happens. If there's a repricing which takes place periodically. So today I'm paying a high cost today. But after 6 months, when the rate comes down, I'm an existing customer who's taken a loan from a bank. Automatically, my cost comes down after 6 months. So there's a resetting which takes place. So today, anybody who's taking a loan knows very well that in a period of 10 years or 15 years, depending on the size, the length of your tenure of your loan, there will be periods where your cost will be high, certain periods where it will be low. So to my mind, it's not a clinching factor. It is a theoretical factor, I agree, but it's not a clinching factor. So after keeping this in mind, again, I'll go back to saying that RBI cannot be behind the curve because they have to target inflation. The mandate does not talk about growth. When they tackle growth and brought the repo rate down to 4%, they said we're doing everything to protect growth. There were unusual conditions. Today we have normal conditions. India is the fastest growing economy, 6.6, 6.5. Government is saying 6.5 to 7%. We're still saying it's a very good rate which we're having. I don't think there is any emergency need to lower the rates in order to spur investment.
When do you expect RBI to start cutting rates?
Actually, Hitesh, if you asked me this question maybe a week back, I would have said probably in February. The reason being that while 2 members of the MPC have already voted for a rate cut, and now when we're talking of the next policy in February, there will in effect be 3 new members of MPC plus a new governor and a new deputy governor. So one is not quite sure as to what would be the perceptions. What I'm talking is the perception of one economist. There are lots of other economists who say that there should be a rate cut, that it does help to bring about investment. So I'm not contending that. All of us have different views. So it will be interesting to see as to how these 5 new members look at the situation, because when they sit down in February, they will be looking at 2 inflation numbers of November and December inflation. Both of them are going to be above 5%. One is already 5.5%. And our calculation is that for December also will be between 5 and 5.5%. So will that give them comfort to cut the repo rate is something which we need to see. But the important development which has taken place is that the Federal Reserve has been very, very cautious. They've actually signaled instead of 100 basis points cut next year, it's going to be 50 basis points. Now, I agree that Indian policy is not driven by Federal Reserve. RBI has always said it's different. But given the impact it is having on currency, it is having on liquidity, the RBI may have to think a bit deeper. So while February could be the earliest point of time, let's assume that we know inflation at 5%, but we've seen onion prices have come back to 20 rupees, potato 20, everything has come down to normal prices. This case for lowering the rate. So we could have a 25 basis points cut in February, but it may be just be pushed to April because of the global factor which has come through. So maybe by the time Donald Trump will also probably say what he's going to do, it may be too early, 2 months, 1 month rather, because it'll be in the first week of February. But it could be pushed by another policy to the month of April, but it will depend upon these evolving conditions.
I mean, sir, RBI has always maintained that rate decision would be dependent on domestic factors. So are you saying that the Fed's decision to reduce rates will have an impact on RBI's decision to cut?
Not directly, I would say, because see, the Fed has already cut rates and we have not cut rates. And we've done some analysis in the past which shows, if you look at a number of times, I don't remember exactly, but if you look at the last 10 years and say, when did the Fed lower the rates and when did RBI lower the rates, I think the majority of the times RBI did not change the rates when the Fed did something.
Okay.
But I'm just saying that today when the Federal Reserve has sent certain message and we have seen an impact on the currency, and today, if you look at the rupee, it has not been depreciating as much as the other currencies have depreciated. So, and every time the rupee depreciates, it creates imported inflation fear. There's also a case of movement of funds. FPI will also withdraw because you say weaker currency, FPI may not be coming into the country. So there will be these other factors also which would be considered. And it may not be a clinching argument for not doing it, but it could be a secondary factor. Because there's no harm in saying that, okay, the inflation is already high, 5% plus, growth seems to be stable, but I see certain distortions or some disturbances in the international front. So therefore, let me wait till April. So that could just be a kind of a justification for waiting till April. It will definitely not be the driving factor. For some reason, Hitesh, just suppose inflation comes at 3% for December. All of us are proved wrong. Then probably it will be an open case to cut rates in the month of February. But since it's not likely to happen, it could be deferred. The federal impact on flow of foreign funds as well as currency would be the ones which would be deciding on, which would be driving the decision.
Sir, whenever the rate cut starts, maybe February or you're saying April, sir, will it be less than or equivalent to 250 basis point rate hike, which we saw during May 2022 and February 2023?
No, definitely not. Because see, again, we have looked at the last 20 years to see as to what has been the average repo rate in India. You'll be surprised the average repo rate has actually been above 6.5. Okay, 6.5 and above. So if I remove all the outlying numbers, I would say that the average repo rate in the country has been around 6%. So when we went to 4%, the 4% was very unusual. It was only time when we touched 4%. Okay, because of the unusual conditions. So I don't think we'll go back to 4%. To my mind, 5.5, 5.75 is where we can temporarily go. but finally we will mean revert to a number of 6%. So in this particular cycle, when they start reducing rates, let's assume by 25 basis points to begin with, whenever it is February or April, till the end of the calendar year, we could be looking at 25 to 75 basis points, a rather shallow rate cut, but I would say we would finally mean revert to 6%. The reason being, I think that inflation in India will typically average around 4.5%. And again, the RBI studies also show that a real interest rate of 1.5 to 2% is required, which means 4.5 plus 1.5 or 2% will bring me closer towards 6%. So 4% in my mind will be only in unusual conditions, not on normal.
So my question on FI, sir. October and November, we saw outflows from FI. December, there was some reversal in trend, but in the last 3-4 days, we are seeing that FI has started selling. What is leading to this sell-off from FIs?
See, actually, when it comes to FPIs, honestly, we really don't know. So if you ask me what's going to happen tomorrow, I don't know. But when we look back on the data and we see what are the events which have taken place, then we're able to do an ex post rationalization as to why the FPIs behaved the way they did. Now, for example, we saw that from the moment they got to know that Donald Trump came to power and we knew what he stood for, automatically we saw a withdrawal of FPIs taking place. We have again seen it when the Federal Reserve has made an announcement. Again, we have seen FPIs moving out. This again, we're talking of primarily the equity market. Now, why is this happening? Because when you're saying that America is going to talk about make America greater again, the MAGA thing which they're talking of. So when you're talking of MAGA, that means that US economy is going to start getting a pump priming. It's going to have a boost. It's going to grow very well. Investors obviously say that, okay, that's the right country for us to invest in. So therefore, they move away from that. Similarly, when you're talking in terms of interest rates, if whatever Trump says will keep interest rates higher or lower levels of rate cuts taking place in America, it means investors will say that let's continue to invest in the US and let's not invest in the emerging markets. So I think this is another factor which has been driving out FPI funds from the emerging markets. Again, I think we should put this in perspective. It's not happening just from India. It's happening from all the emerging markets for the very same reasons. And besides, we should remember another thing is that after we had the Lehman crisis, we had quantitative easing, which meant there was a lot of free money which was floating. From 2014 or 15, I think quantitative tightening has started in different ways. So the overall quantum of investable funds itself has come down. So A, the quantum of investable funds have come down. Second, the different markets are showing up, are growing in different ways. Today, even Vietnam is an interesting market for foreign investors. It wasn't so some time back. So same thing holds for Thailand, it holds for Hong Kong, it holds for China, it holds for India. So there's a more competition also taking place across different markets because everybody is looking at what's happening in these markets, looking at alternatives. And then, of course, because I think we have that advantage that Indian markets are still priced attractively. Some may, of course, argue I'm not much into stock markets. I haven't done too much studies. Some feel that the Indian market may still be overvalued. But I think given the fact that the Indian economy is going to grow at over 7% next year, that is what our forecast is. I think it means that the stock markets are going to deliver fairly reasonable results even in 25. There's no reason why FPIs should be withdrawing. But I think there are lots of these external factors which work in favor. In fact, I think one of the reasons which has worked in our favor has been a stable rupee. The RBI has sold dollars and that has made sure that the rupee is less volatile. Because even if the currency tends to be very volatile, that becomes an additional cost for a foreign investor coming into India.
My last question, then we'll move to audiences. Sir, what's the outlook on credit growth? We have seen some moderation in credit expansion. How is it going to be in the second half?
See, we expect credit growth to pick up in the non-retail sector. Okay, because we are still looking at credit growth in the region of around 13 to 14% for this year. Currently, on a Y-on-Y basis, we are lower than less than 11%. But if our whole hypothesis of GDP growth of 7% in Q3 and Q4 is to fructify, it will automatically be associated with greater demand for funds, especially from industry. Now, if you look at the overall pattern of credit growth in different sectors, what is it that we see? We see that credit to industry has actually picked up, especially to large corporates, which means there is some activity going on. We would like to think it's happening in the investment space. What has slowed down is primarily to the services sector, in particular to NBFCs and to the retail segment. And even in the retail segment, we have seen that there's been a substantial slowdown when it comes to unsecured loans. Now, this will just take me back to last year, to November 2023. The RBI saw that unsecured loans were growing at a very fast tick. So therefore, they brought in some new capital norms. And ever since they brought in these capital norms, we've seen there's been a slowdown in growth of unsecured loans. It's still high. I think it's still in the teens, but it's definitely come down from the 35% growth which we have seen earlier. So with credit growth, I think we'll probably continue at this pace of 13 to 14%, provided I get my 7% growth, and it will be largely driven by the manufacturing sector. And just for the sake of the audience, you say that when credit to NBFCs has slowed down, they were also under this new capital provision norms, where the banks were charging higher rates for them. But the NBFCs have actually migrated to the corporate bond market. So they're borrowing from other sources. Their business is also keeping pace, but their sources of funds is less from banks and more from the bond market.
We'll just ask few questions from audience. We'll take some questions from audience. I'll request Pragati Mishra to ask her question. It's not there. Okay, next, we'll ask Shivanand Mohanty to ask his question.
Hello.
Pragati is there. Yeah, please go on.
Good evening, sir.
Yeah, good evening.
Sir, I want to ask that what factors are contributing to the declaration of GDP growth in the current economy?
Okay, in the current year, as I explained in the beginning, we have seen that it's primarily the industrial sector which has underperformed. And within industrial sector, there are three components we have. We have mining, manufacturing, and electricity. Mining and mining and electricity were handicapped by what we call a high base effect. When I say a high base effect, we saw growth in the region of over 11-12% last year. So automatically, there was a tendency for the growth rate in the current year, that is the current quarter, the second quarter of this year, to come at a lower number. Now, in terms of manufacturing, we saw there was a certain amount of stress which came about on account of urban demand being lacking. That's one. And B, because of certain kind of religious factors too, we saw a lot of postponement of consumption in the month of September, which should have taken place, because in September also we had quite a few festivals in India, but they got deferred to the months of October and November. So there was a case of demand, urban demand coming down. There was a festival effect which probably kept some part of the demand down. So that is what actually contributed to slower growth in manufacturing. Otherwise, the services sector has been doing exceptionally well. It has been quite contrary to what we have seen in the manufacturing sector.
Pragati, do you have any other question? Okay. We'll move to Shivanand Mohanty. Shivan, can you please ask your question?
Yeah, can you hear me, sir? Good evening.
Yeah, sure. Good evening.
Okay. Yeah, thank you very much for very interesting insights. I just wanted to ask you, you had mentioned, and this the question I had was there we are expecting distortions and disturbances in the international scenario. And would you know of any country which has managed these disturbances by monetary policy? I mean, is there any way policy can help the Indian economy be a little bit more resilient to these changes?
See, when you're talking in terms of policies, see, the budget cannot do anything. Monetary policy per se, when I say monetary policy, repo rate cannot take care of these things. But I think the major problems will come from the point of view of trade. So there is something on the trade front which has to be done as to how do we make our exports more competitive. Now, India has been talking for a long time about China plus one policy. How do we make sure that we are part of global supply chains where we're able to push forward our exports? The PLI scheme has also been brought in. It hasn't been very successful in all the industries, but definitely for mobile sets, it has been very useful. So trade policy is something which could help to counter, but we should remember that we are going to be competing with so many other countries, which will also be doing something on the trade front, either through pricing or through the exchange rate, or in terms of the overall quality of the products. So that's something which can be done. But I think from the point of view of policy, the way we can counter, it's more a case of countering the negative impact which comes in terms of what happens to currencies. That comes back into the forte of the Reserve Bank of India, where there will have to be certain proactive steps taken, a decision which has to be taken. How do we make sure that the rupee does not slide down too much? But I don't think monetary policy per se, that is the repo rate which we're talking of, is something which will actually help to counter it, because what could possibly happen in America is something which is dealing in physical goods, which would be impeded or become more expensive when the tariffs are imposed.
Thanks, Shivanand. I'll request Milan Mehta to ask his question.
We can take the next
Okay.
question.
Mr. Radhakrishnan Shenoy, can you please go ahead?
You're on mute, I think.
No, I'm not, sir.
It's his name, Radhakrishnan.
Hello.
Yeah, hello.
Yeah. Good evening, sir. I wanted to ask of you. Now, I hear that a lot of corporates, especially in the consumption sector, are reporting very poor rates of growth. Now, there is also a sense of listlessness because the citizens are finding the cost of consumables very high. And is there any way the government of India can step in and help by rationalizing the rates a little bit downwards for GST for various essential items? This is my question to you. What is your view on this, sir?
See, I think the suggestion which you have given is definitely pertinent, something which will have to be taken up by the GST Council. I think they're having a meeting soon. I don't know if it's tomorrow or if it's another Saturday, but they're going to have a meeting where they're going to be looking at the GST rates. But I think any decision which is taken by the government will be more long-term in nature. So if the current setback for consumption goods is considered to be temporary, it looks unlikely that the government could take any step out here. Now, this said, I should also say another interesting thing which we have realized when we have done our own surveys and talking to certain companies as well as to consumers, is that while consumption has been affected definitely in the organized sector, but in the unorganized sector, we have seen the comparable products doing very well. Because if we look at the rationale, it say that, look, all of us use toothpaste, all of us use soap. Now, if the soap I'm using has become very expensive, which is being manufactured by, say, a multinational company, there's been a tendency for people to switch over to local products which come at a lower cost because they have lower overheads. I'm not quite sure how the quality is, but definitely if people are buying them, they are of acceptable quality. So there's a large bit of substitution which has taken place from goods produced in the organized sector to the goods produced in the unorganized sector. So I think there's a case of a bit of innovation which has to come from the organized sector, where they will have to go back to their discussion table and see if they need to be innovative, try to bring out new products which are more cost effective. Now, I don't know which age you belong to, but when I was a student, I remember we only had one particular powder called Surf, which we could buy in the market. And that was a premium product. Then we had another product called Nirma, which came in. So when Nirma came in with washing powder, and they were selling at maybe 25 or 30% of the cost of Surf, we saw there was a great migration which took place in Nirma. Now, what did Hindustan Levers do? They actually brought in a product called Wheel, which still sells in the market. In fact, I think Nirma is out of production right now. And they brought in a cheaper product, good quality, something which was able to gather the attention of the masses. So I think companies will have to also go back to the discussion table, see do they need to innovate, bring out cheaper products, something which appeals to the people, because people are going to be more price sensitive, because inflation is going to be something which we have to live with. Food inflation today may come down, tomorrow again it could go up. If I have a onion crop failure, again consumers are going to become discerning when it comes to the products. And since we have seen a bit of substitution taking place based purely on prices, there could possibly be some action which has to be taken from the point of view of the corporates. But from the point of view of the government, yes, GST is definitely something, but I don't think they will go in for it unless they think this problem is a permanent one.
We have last question from Sanjeeva. Can you please ask your question?
You're on mute, Sanjeeva.
Sorry, is it fine?
Yeah, it's fine. Please
right. Mr. Madan, I agree with most of the things that you have said, but this company is going back to the drawing table and redraft their strategies and all, both manufacturing and marketing. But where's the money? the money which is made available by the spender to generate heated markets, or you see during COVID time, as per RBI data, the saving rates of the country was very high. It was very decent as compared to 2017, 2016, 2018, 19, 20. We had a very bad GDP growth. And of course, cascading effect was that all these years, saving rate was pretty low. But 2021 and 22 and up to 23 mid, saving rates were high. Now that money got unleashed, and that was spent by people, especially middle class, in 23 full and 24 full. Now, please, Mr. Madan, I would like to know that this money which is being spent by lower middle class and the three segments of middle class has got exhausted, because the lowest of the people, I mean lower middle class, is not having money. I travel in the interiors of the country and I realize that people have no money to spend. Now, how will growth be generated for producing more and more? Because when there will be no money, how will the business cycle will evolve finally? So my point is that talking about increased rate of GDP and all, I personally feel that this GDP is going to go further down in 2024-25 and further again on 25-26. Just establishing 5 big companies in the country operated by US and all, it is not going to improve your GDP. It's not going to distribute money equally. Ultimately, the small and cottage industry has to be evoked again, with same spirit as it was done earlier. Now they have been killed. I travel as a trained banker. I travel very extensively to interiors, and believe me, I'm shocked to see that most of the industries which were having, say, a turnover of 2 crores and below, they have been finished actually after demonetization. Your answer.
Okay, I think it's a fair point which you have made. But in a way, we look at it is that when we are talking in terms of consumption and investment picking up, it's going to happen at a very gradual pace. Now, what's going to be the crux of the entire thing is that are we going to be creating more jobs? Because finally, when we're talking of spending taking place, consumption taking place, it's a case of income being generated. And for income to be generated, we need to be having more jobs created. Now, this is where there's been a lot of controversy out here about whether jobs are being created or not. Now, I would tend to believe that we have created a large number of jobs, but they have been in the low income groups. Delivery boys, we're having a lot of construction workers which have come in. So there will be this problem of saying that do they really have the purchasing power to go and keep buying ice creams and buying these fancy, cosmetics or so on and so forth. That may not really be the case. So it's going to be a slow evolving kind of a process which happens. So as we keep creating more jobs, it's all, I would say it's a kind of a chicken and egg kind of thing. As consumption picks up, automatically there's a case of more investment taking place. It's not happening in a big way, mind you. Then you keep employing more people, there's more income being generated, there's more spending which takes place. So it's going to be a very slow kind of a process which is going to bring about this growth. I'm not talking in terms of accelerated growth or anything taking place, because I think the point you made in terms of the SME segment, it's a very pertinent one, because we've also noticed that the SME segment got affected both on account of demonetization as well as in terms of COVID. And the number of these units have actually closed down. But I think there's a lot of effort being put in, at least from the financial side by the government, to make sure that there's more credit being provided to these units. And I think it's been fairly successful. We've had a lot of successful stories in the banking sector about how lots of these units have gotten revived. But I agree it's a long distance to go. And since SMEs are really the backbone of our economy, because they provide the largest amount of employment after agriculture, and also the fact that when we talk of exports, any kind of supply chains, it's all SMEs. So I think the focus will have to be on SMEs to try and revive them, make sure that they're more commercially viable, and more importantly, that they're able to exist so that you're able to create more employment. Because this is one segment, they may not be employing too many people at one time, but even 4 or 5 people being employed by, say, 50, 60 million of these SMEs, which we have, will have the potential to actually increase. So it's going to be a slow process. I fully agree with you on that.
Sir, that was the last question. Thank you for an insightful session. It's always a delight to listen to you. I'm sure our audience has found this session to be highly informative. And thanks to all who participated in, attended the session and participated in this. And lastly, thanks to our partner, Plutus IS. Thank you.
Thanks a lot.